Just are type in where you are calling from. And I bet we got some people from all over. Wonderful. But a little bit about Truist Bank. For those of you who are in the Carolinas, you may have seen that. That is the merging of SunTrust and BB&T Bank. Greensboro, very good. From Norlina, San Fran, love it. Very good. Truist Bank is a recent merger of SunTrust and BB&T Bank. Both companies collectively been around for over 100 years, but we came together for a couple of reasons, but one of them is something that's near and dear to this crowd. It is our Philly. Nice, love it, Jasper. Our need for technology. I mean, that's what our customers expect. The world is being Amazoned and Google-fied, so we need to have good people like myself in places and good offices, but we really need the technology. And shoot, I'd love it if the interns on this call became future Truist coders one day. That would be a pretty cool connection. So why Code the Dream? Well, Code the Dream, as you know, really makes a big impact. And Alex and I were just talking right before you guys got on there that, you know, the culture there is really one that builds people up. And Truist recognize that as well. There's a banking department called CRA, Community Reinvestment Act. And the CRA team really was birthed out of just some injustices that banks were committing back in the day, you know, redlining, unequal income distribution, just a lot of the social problems that we still face that are very real today. You know, banks, unfortunately, were not helping that. So along came CRA, Community Reinvestment Act, and initially it was to make sure that the loans we were offering were fairly spread across. We didn't, you know, redline one neighborhood and exclude anyone, but it's also kind of evolved in a good way. The bank has a portfolio of partners like Code the Dream, where you know, we're a sponsor to them, but we really count on them using those funds to go into the community and to make a big impact. And it definitely is. We just got a report from our CRA department specifically about you guys, about Code the Dream. Talked about the wonderful placements that have been made. And, you know, that's such an encouragement, and each of you should be proud about that. Your organization is, you know, making an impact in the workplace, but really forging a path for next interns. And it's, you know, I made it a personal goal of mine. We get little announcements from our CRA team. A little while ago, they had Killer Mike. I don't know Killer Mike before this, but he's a music artist, and he started a fintech, financial technology company, and we became a partnership in that. So I've made it my personal goal to see Code the Dream on our bank's announcement list as you know, a headline partner. I think that would be pretty cool. So that's a little bit about why Code the Dream and why Truist. A little bit about me, why I'm here today. I've been in banking for over 14 years. I love it. It is a crazy industry, but an industry I love. I couldn't think of anything else. And I've had a lot of roles and different experiences, but what keeps me excited to come to work every day is the real possibility that I will be bringing the bank to somebody. Maybe it's you, maybe it's a customer I see later on today, but to somebody the way they haven't had the bank brought to them before. My office is a multicultural branch. I'm in the heart of downtown Durham, and believe it or not, we have a lot of ethnicities and a lot of cultures and nations that are represented here. So we help a lot of clients from the Americas, from the Caribbean, from Africa, from Europe as well, just really all over. And it is the best thing to bring the bank to those families. A lot of cultures are very trust and family driven. And so, their families back home, they don't have somebody along here with them, to walk them through a big experience. Maybe it's college savings like we're going to talk about today, or it is, saving for a house like we're going to talk about in the future. But the familial aspect for a lot of cultures is very strong. So if their families back home, they don't have that. So I really work hard to fill that gap, come alongside of small businesses, and it's just the best thing ever. So I am really excited to be here today. And the goal today is to really introduce you all to the concept of 529 savings. Couple full disclosures, two that I'll make clear. One, I would love each of you to become Truist Bank clients one day, but that's not a requirement. And let's say you had the sense that this is good. I want to set up a 529 plan for my family. I couldn't help you. Our bank doesn't offer this product. The other full disclosure as well is a lot of this has a strong investment component. I am not a licensed investment representative. You don't see a lot of investment companies that give these talks just because there's a lot of liability to it. So what I don't want you to come away with today is say, Jason said this 529 plan is going to make me a lot of money or it's going to lose a lot of money. Really, I want to introduce you to the concept and just get you thinking through it. And then you can become educated on it on your own terms. Each of you have proven yourselves as being self-starters and inquisitive and learning how to troubleshoot things. So think of this as another coding assignment or something new that you can wrap your arms around. So I think I did enough on the front end. I saw at least one more caller come in. So welcome, callers. We are about to dive into 529 savings. So let's go to the next slide. So the three big things I want this to revolve around is defining what a 529 is, what your plan options are, and again, those questions, things to get you thinking through this. So ultimately you become empowered in your decision making. One of my first meetings with Dan Rearick, your fearless leader there, is that he started Code the Dream out of that concept, just empowering people, giving back, make it a community that's lifting everybody up. So that's the goal today. Next. So here is the definition of a 529 plan. The two big things that you want to come away with it is tax advantaged. So that's the whole reason people go through this step. And it is for higher education, for college. So those are the two things that this revolves around. It's a tax advantage savings plan designed to encourage savings for future education, legally known as a qualified tuition plan. They are sponsored by states. So again, I don't have a hard and fast formula. I don't know what the costs and structures are for each of the states, Pennsylvania, California, North Carolina, and whoever else may have joined us. But I at least want to get you pointed in that direction and get you thinking through that process as well. It's pretty nuanced just because there's a lot of tax codes that fall in line with each of those. But college savings is like a lot of things we see in our economy. There's a social good for people saving for college preemptively. You see that with people's retirements. We have a social security system, but there's also encouragement to save for retirement through a 401k or an IRA. Home ownership, there are mortgages, which we'll talk about next week, that are supported by the government, but they're to come in tandem with people so that they can achieve those financial goals. Next slide. So there are two broad categories, and I'll just let this sink in for a little bit. You have tuition, so prepaid tuition, and that name kind of describes itself. So you pick an institution or set of institutions. I'll use my great state of North Carolina. You choose to prepay college education for someone in your family towards that school. So if they want to go to university, one of the great universities in Georgia, that is not what carries over. So that is your prepaid tuition. There's means, and you could consult with your tax advisor on how you can recoup some of those funds, to still benefit that person. It's not like the money just goes away, it's there, but you'd have to consult a tax expert to figure out what the cost and implications would be. The other is your education savings plan. So we'll spend more of our time today around that because I think that's what we can all see and visualize better. You have your savings account for you have your savings account for your vehicle, for your living situation. This would be a savings account for a loved one's future college expenses. Education savings plans, I wrote down some of the differences that people tend to look at. So if you do prepaid, that will pay for your tuition and your mandatory fees. One thing it doesn't include, though, is room and board. You might say, well, why is that? Well, it is, again, for prepaid, you are sending money to an institution earmarked for a specific expense. But let's say you stayed in the state you paid for, but you decided to live off campus or live with family members. It's not as clean. Therefore, it's harder for the prepaid track to document all that. But that's not the case with savings. Savings, there's some criteria that you need to prove that it's for room and board, and then it is covered. Tax efficiency. So let me go through this at a high level. More often than not, there's two events as you are setting aside a money for someone's future college expenses. You are putting the money in there. So most of the time, you will get what we call an income deduction. So I'll just use round numbers here. Someone who has a monthly income of $1,500. If we multiply that out through the year, that's $18,000. So somebody who has an $18,000 a year income, they could have a deduction. Let's say they put money into one of these accounts of just $100 per month. So that would decrease their income for the year by $1,200. So again, your income is $18,000 for the year. You hear the term income deduction. This could count as an income deduction. So that's the first place where you have a tax benefit for you. The second place where you'll see it, and we're going to break down some savings potential paths, is as the money grows. So the way our IRS is set up currently, there's a lot of taxes, and you might have heard that from family members. You get a lot of tax here, you get a lot of tax there, and where is all this getting paid to? Well, one of those, for good or for bad, we're not here to debate, policies. Those are outside of my expertise. But the way it's set up now is as you earn the money, there's the potential for it to be a tax, and then as you invest it and grow it, there's the potential for it to be taxed. So a double taxation. These 529 plans offer you two tax incentives to where it can lower your income by how much you put in there, and you can avoid federal tax on the money that grows. So I'll let that sink in. Growth money, potential for not having to pay tax on it, because that money is, again, sent for someone's college expense. Let's go to the next slide. So this is where I need some help. You can use your calculators here. I don't know if a true calculator would work. But we're going to just use the scenario of $100 monthly contribution over 18 years. So let me break that down. Where did I get these numbers from? So let's say in your family there is a newborn. Within 18 years, there's a likelihood that that newborn would want the option to have higher education. So most of these plans are kind of geared around that. The first 18 years of someone's life, $100 per month. Well, where did I get that figure from as well? That equates to about $25 per week, or if you break it down per day, that's right around $3 and change per day. These accounts are tailored for a lot of different budgets. So what I don't want you to do through this is to see the $100 figure and say, Well, if I could do $100, I wouldn't be on this call today. You know, I'd be off investing that money, or I'd be doing something with that. So I don't want you to think that the $100 was just, frankly, was the easiest to put on these PowerPoints and help you see that. So let's go to the next slide. So what I have in there is, if you had invested $100 per month, again, for 18 years, and I assumed an interest rate return of 6%. For a lot of market indications, that's kind of conservative for, you know, what the general stock market has done. If you would have had money invested this past year, the average returns were 20 to 30%, but that's an average. Past performance is not a guarantee of future performance. So most financial writings that you'll see when they predict someone's money and the track that'll grow, they use 6%, which is what I did here. So one thing I didn't put in here, but somebody with a calculator, this is an easy calculation. What is $100 invested for 18 years? So you'd want to multiply $100 times 12. So that's 12 times throughout the year times 18. Somebody put that in the chat. $21,600. So remember what I said. Thank you, Jasper. Beat me to it. That's all right, Lauren. I got more of these. So you're up next. For the tax implications, so that $21,000 has the potential to have lowered your income. So that's a tax benefit. When you file your taxes, that's $21,000 less of taxes that, or less of income that you may have to pay tax on. But the bigger thing is the $21,000, or I'm sorry, the difference between $21,000 and $38,000. I won't throw this up as a question. I'll do the math in my head. That's about $17,000 worth of growth. That has the very real potential for tax-free growth. So I say potential because, again, depending on what plan you get into, if it fits all the guidelines, that extra $17,000, the government won't tax. They want your loved one to get the benefit of having their education paid for. So now this one's a little bit different. I won't give you any tips just yet. I'm curious to see which of you coders can figure this one out. So let's take that same $38,000, because I really want us to think out loud. You know, just as we all go through life, there's so many decisions we could make. And by making one decision, we exclude an infinite possibility of other decisions. So if I say I'm going to commit to $100 monthly for savings, there's a bunch of other things that I exclude. So let's flip the switch and say, okay, I'm not going to save the $100 per month. You know, I was in a position myself, you might be saying, where, you know, I went to school, I took on student loans, and I did okay. I'm here right now. It wasn't the best, but, you know, I did okay. So let's look at that same $38,099 and look at it through the lens of a loan. So somebody compute for me, what would be your monthly payment on a loan if you were to owe $38,000 today at an interest rate of 6% and you paid it back over 15 years? Anybody? You can Google it. That's fine. What is your monthly payment? Lauren's given the floor. And it's okay if you guys don't have it. It's on the next slide. I'll give it just 10 more seconds if somebody wants to be bold. All right, Alex, let me tip the answer. So you would have paid $321.50 per month over 15 years, or $57,000. So let me rehash those numbers. Someone who made the commitment this year that says, I'm going to be able to put $100 aside. I'm going to grow that at a rate of about 6%. Within 18 years, that'd be worth about $38,000. That same person that says, you know, flash forward 20 years of my life, I am now a college graduate and I owe $38,000 in student debt. I'm going to repay my loan. at what the market bears, which is about 6% for 15 years, that person would have paid $57,870. Or to make it more tangible, on a monthly basis, you would have had to have saved $100 to get there versus paying $321. And that's just a small glimpse of, the way our finance system works. Compounding interest is either a wonderful thing or a really tough thing, depending on what side of the equation you're on. For people who are in a position to save and invest, they get that growth. They're investing it with companies who are basically borrowing that money for you, and then they pay it back in the turn of investments and dividends. Versus if you take the loan yourself, you have to pay that interest as well. So, I've worked in finance for a long time, and I've helped a lot of families, go through this. And I've seen different people on different sides of different positions at the table. If we have a metaphorical table here, I've helped the recent graduate who has that debt, and they're really nervous just because they're trying to figure out job prospects, they're trying to figure out living situations, and they think they can afford that payment of $321, but they might not be able to. And I see, really the stress of it all is really tough. I've also sat with families who have that newborn. They come into my bank, they only got about 5 minutes because the baby's about to wake up. But they've been given some gifts from their family. They say, we want to do something for this child. So, I recommend a couple options, but this is one of them, that they consider, them putting forward the $100 today to, to help benefit future college. Another place that I've sat at, and you don't think of this for a college savings discussion, but it kind of fits, so just bear with me. We help people when they have kind of their final testament on life, their final wish of their, all their assets. And you'll meet the families that are affected by it. And sorry, this just became like serious real quickly, but if somebody's last wish on earth, whatever assets they have, usually they give it to them in one payment, whether that's $100 or in this case $38,000. And you see some cases where the money is used for a specific need. They go and buy a house, they buy a car. Sometimes they start a savings account so they can go turn that into a blessing to somebody else. But sometimes you see the cases where the money is spent really quickly. We've all seen the news headlines of, people who get a quick windfall of money. And then I think there's a show out there, How the Lottery Ruined My Life. I don't want to stretch to say a college expense is winning the lottery, but you get the point that putting money aside over time for college has the real implication of just a lifelong benefit. And then, somebody opting to go into, or not opting, that's not the choice they had, it's the only choice they had, but experiencing student loan debt, you see the cost to that. So let's move ahead to our next slide. Okay, so I have in front of me, these are some statistics that I just researched, and this kind of gives you a bigger scope of what college expenses look like now. So we'll go back to my chat feature, and I just need 4 answers. So it's not a trick here, but 4 answers, and I'll write them down. So somebody put in the chat box, what is the average student loan debt of graduates for the year 2020? Pick a number, any number. 100K, very good. Somebody else, what is the average student loan debt of graduates in 2010? Anybody guess? 60K, all right. Somebody else, what is the percentage of college graduates? We'll use US college graduates. That's where I'm pulling these numbers here, with student debts. So this is the number of people who graduate. What percentage of them carry a student loan in 2020? %85. Lauren, you got my back here. You're going out. I love it. And then, well, I'll just bring this last question to you. Percentage of graduates with student debt in 2010. What do you think? 50%. Wonderful. Well, let's flip to our next slide and we can take a look to see what those are. So in the year 2020, the average student loan, no, that's okay, Lauren. You were right in the mix of the numbers. 2020, just shy of $30,000 was the student loan debt balance. The year 2010, 25,000 was the student loan balance. The next number you would think, just with a growing balance. Yeah, and I agree with you. This is capturing undergraduate. Well, actually, that's a good question. I don't know if it's catching. No, I'm sorry. This is undergraduate debt. So a combination of associate's degrees and bachelor's degrees. 2020, the percentage of people who had this debt was 64%, but actually in 2010, it was a little bit higher. So I don't know, I'm not an economist. You could attribute a lot of theories to that. Certainly, no, it didn't say between public and private schools. Or at least the source that I used. It didn't break down the difference between the two. But I mean, it's safe to assume private school would be on the higher end, public school would be on the lower end of that. But I think, and these are just me shooting from the hip here, that those 2010 numbers, I find it, I certainly don't like to see people's school balances growing, but I think that reduction in people who have debt is promising. That's a promising sign. It shows probably a combination of a couple things. On the policy side, there's legislation in the works to control prices. Yep, it is a lot, Jasper. And there's work that is being done to reduce prices. There's also talks like we have today. Who do we know that's on this call today, when it's time for them to support a family member or loved one, that they might say, I want to do this. And the real thing that I wanted to show you is, let's just look at that $29,000 mark. We flip back a few slides and we don't have to do that. But if we did, the scenario we used was $38,000. So if somebody would have saved less than probably $75, maybe $50 a month, how less number of people would have that 29,000. And it starts small. We're polling a big population of people, but what if the trend more and more became that it was just acceptable and the norm for people to start saving money for small children at an early age, $50, $40. I don't have an investment calculator in front of me, but I bet, there we go. I bet if you were to lower that number to say $75 or even $50 a month, you'd be really close to $29,000. And then you leave your child with the option of, what do they want to do once they're done with undergraduate degrees? And that's just the case with a lot of personal finance things. We see these grand numbers with a lot of zeros at the end. And I've gotten to meet customers like that. They've sold a business, or they've worked for a company for a long time and they retire and they have this check of money, but it's just, silly little things that they did the whole time. They packed their lunch every day. They would take the bus to work, or they would drive the same car for 15 years. It's very small behaviors that they changed. So let's keep on going back to our, there we go. Next slide. So why do I have a picture of lovable cows on there? That's supposed to be a farm. I thought that was a good farm picture, but I use the phrase with customers because I do hear people say that, I wish I would have been told this 20 years ago. I wish I would have been told this a long time ago. So I like to use the question, when's the best time to have started a farm? Well, 20 years ago. The next best day is today. So what does that look like? Starting a farm, but for your finances and your money. Go ahead to the next slide. So let's try some of these links right here. I asked Alex to get them keyed up, but I'm a big proponent of knowledge first. Knowledge ultimately will drive your beliefs. Those beliefs will drive your behaviors. So you really have to, rightfully so, we need to trust the sources of where these funds go. And that just gives us more drive and more willingness to set them aside. So we'll start with that first one, getting started. So this website here, collegesavings.org, is a really good place to do that. Each college savings plan is broken down by state. So if you explore this website, you can look up California, for example, look up the savings parameters and what the costs and the structures are there. And from there, figure out what the best plan of action is as well. Right now we're in a day and age of TurboTax. So you can probably Google a lot of the tax questions, but if you go to the SEC page, just right next to it, that defines some of the terms that are around it. Most people that get a pay stub or a W-2 earner, they can have most of their payroll questions answered. But some of you currently, or maybe in the future, you use your training here to go own your own business or become an investor in other people's businesses. Your tax situation just gets more involved. So you can get a framework from there, but a CPA or a tax planner is really helpful because you can know the implications of taxes, but having someone to plan and give you those next steps of, what should I do now for my family? What should I do now for my business? It goes a long way. So let's go back to the slide. Rounding the bend here. And then I want to give the floor to you all for questions as well. So I've heard this question before, and people who haven't said it, they may be thinking it. They say, all right, Jason, I hear you. I have someone in my family that I want to support, or, somebody that I know who could really benefit from this. I'm ready to do it, but gosh, 18 years, that's a lot. A lot could change. I might, pick a winning lottery ticket number, or I could have a lot of hardship. What if COVID 2.0 comes and it affects my industry, it affects my livelihood? What if I start this and can't commit to it? So very broadly speaking, these plans, they aren't like a loan where it's a contract where if you say, I'm going to start for this payment amount, you have to fill it. It's really more like a savings account. So all of you have the ability to put as much or as little or no savings aside as you want. But the other thing I've heard people say is, I'm in a good position now, but I have family who may need me. So they, I'd love the option to pay for somebody's college expense, but I know somebody who has a medical expense or a housing emergency expense. What if I need that money for that? So I put 3 buckets up there because that's a common analogy used in personal finance. You plan your savings and your banking in stages, or in this case, buckets. So the one on the far left, that is your day-to-day bucket. You are able to comfortably pay for all your immediate expenses, food, housing, day-to-day necessities. Once you fill that bucket to a comfortable level, then you have what you call your savings. So your savings is money that you don't anticipate using on a daily basis, but it's certainly possible. So vehicle expenses, healthcare expenses, just things that you wouldn't have known today, but they end up end up coming up. And then that final bucket on the right is your kind of long-term. Now I'll call out something that I see as a real thing. There's kind of savings shame or savings guilt. I'll have a conversation with someone, and I've felt this way as well, where I said, you know what, I just need to save. I need to just stop talking about it and just do it. But things happen in life, or things happen in our loved ones' lives where we can't in good conscience keep money when we know somebody else is really struggling. So we use the savings that we have to go do that. So the prospect of doing additional savings like a 529 plan is just kind of discouraging. We shut down. We say, no, I can't even do the savings I have. But I would argue against that. I mean, the whole purpose of savings is for you to have money and for you to use it richly in your lives and richly in the lives of those around you. And nobody can say that they're going to start an account and know exactly where the money's going to go, just because there's so much life that happens in the life of a child and your life. So I guess I just say all that to say, you want to use, you want to think to the prospect that once the money goes in there, you don't want to use it for other expenses because there's, there's tax consequences and all that. But I don't want people to have savings guilt. I guess that's the best phrase I can come up with. It is a thing that I see. I've experienced it as well. And, there's no guilt. You save money to help for a future need. And if that need isn't exactly what you thought, at least you had the money there. So I think that is the end of our slide. Questions. I saw a lot of people join towards the end, but what questions do you have for me? Well, it doesn't sound like anybody has any pressing questions, which is fine. Somebody liked the cow. Me too. That's why I picked it. Thank you, Cassidy. I believe that was a cow or a dairy farm up in Wisconsin. I have Wisconsin roots in my family, so I thought it was cool. But when we finish this today, Alex has this deck, and towards the end, those are the websites that I would encourage you to go to. But also, each of you know these as people with a technology influence. Once you start researching savings for college, your browser and cookies history is going to just fill up with them. And just because you read it online, even the things you're hearing from me or the things you see from here, I would encourage you to take a trust but verify approach. A lot of times I see where people, again, kind of going back to the savings guilt, they just feel like they haven't saved enough. So they start later in their life than they would have want to. And now they feel like they have to make a lot of money just to cover the savings goal that they have. And just like you never want to feel guilty for not saving, you don't want to feel guilty and save and put your money at more risk than it should have. There's a reason that these college savings are pretty regulated by the states that they're run through. There's not a Bitcoin college savings plan or any, a welcome to Las Vegas college savings plan where you go to the roulette table and hopefully junior their number is called, otherwise no more college money. So I would encourage you to start small and really start with the research piece. I will be back next week to.
I have a question.
Yes.
Random question. What if you never had the chance to save up before? You just couldn't afford to do it, and now your kid is like 14. How do you even go from there?
Sure, that's a great question. So college savings is one of many options for college funding. And depending on your family situation, depending on the student's college funding situation, FAFSA, F-A-S-A, is the national heading under which students can apply federally for student aid. There is just an unbelievable amount of funding and grant opportunities that are out there. You have to work for them, and they don't just come to people. You really have to seek them out. Also, I'll use my family as an example. My beautiful bride, she is a professor at UNC Chapel Hill. Go Heels! And within her school, there are many, many different programs to benefit the state of North Carolina. So that's right, Lauren. And within the school, there's different groups that students can join, which they'll get paid. They'll get stipends. That will help offset the cost of their schooling. One of the things that I encourage families to do is start having these conversations. I've told you, I've seen the case where a newborn is brought in, and that newborn, that bank I used to work at, I was almost there for 10 years. So I just kind of followed families as they grew up, and eventually that newborn starts getting checks and birthday things from family members. So there's only so many toys that the baby can have at one time. So they, as they get a little older, they say, well, let's start a savings account. So I would really engage in conversations with your loved one, your child, family's child member, and see how they can become a part of it. Now, granted, you are working to support them, so you could make the argument if, why would they be able to put money in if you couldn't? But, you can look at things that says, what if, you want to do this extracurricular activity? I'd love for you to do it as well. Maybe we can modify it a little bit. And even if it just saves us $5 a month, that's $5 a month we didn't have before that we can put towards it. And the bigger thing is it will get that person who is in their teens, who just doesn't, they don't sit on Zooms like this. I guess in COVID, they go to Zoom school, but, they don't have these thoughts and these conversations. When they are going to school, they're thinking about experience and friends, and they don't know what they want to do. So once they start to think about finances, like a lot of things in life, I think you as the parent would want to be the one to first tell them about it, rather than hearing about it from someone you don't know or trust, or from the internet. You want to steer that conversation. So I think, there's multiple funding options for that student, but I think the best one is, talking with your child now and saying that, what if we, you and I thought up of something together. One, it would produce money. $5 per month is more than $5 per month if you wouldn't have started it. But also, once they get there, they'll take school really seriously. What if you would have saved all this money? They would have gotten scholarships in high school, but then they get to college, they don't do well, and they start losing their scholarships. That doesn't make good economic sense. But I bet you the person who has a firm grasp that, wow, there's a cost here. They're going to take their school seriously. They might be able to finish early. They might, buy their books used rather than getting them all new, and they'll do research on their own. So it will push that person to become more resourceful. Yeah. So hopefully that addressed your question.
Yeah, thank you.
You're welcome. Any other questions? Not to worry. Well, again, I am the last thing between some of you and the rest of your Friday. So feel free to send Alex questions. She has my information. And please come back next Friday. We will be talking about buying a home, and I'll have at least one special guest with me. His name is Mark. He is the home loan expert. So come ready with all your loans. We'll talk about home hack strategies and just some really cool things when it comes to buying a home. So have a great Friday, all, and we'll see you next week.
I'm sure you'll have a lot of more questions next week.
Very good.
Thank you so much, Jason.
Thank you, Alex. Thank
Yeah.
you all.
Thank you. See you.